Hey everyone, how you doing today? We're on with Anna Kelly, and topic number 2 is something I'm seeing a lot in the comments on this channel, and that is, oh my God, rates are rising. What do I do? Should I buy now? Should I lock? All of those things. So, Anna, you and I have been doing this a while. We've seen rates and LTVs and all kinds of stuff change. How concerned are you about rising rates?
I know that rates are going to continue to rise. They are the lowest that they've ever been in my lifetime, right? In the last week, they've gone up about 0.5% or more, depending on the index that your lender is using. But let me just tell you that that the residential mortgages have gone up, I think 0.8. So they've gone up even higher. But I got a mortgage on my house at 2.5. I got a mortgage on my last investment property at 3.5. And I'm about to get another mortgage on a property 2 weeks later at 3.75. Am I thrilled at 3.75? Absolutely, I'm thrilled at 3.75. Would I have liked it to stay at 3.5? Sure. Or 2.5? Sure. But the reality is very few of my mortgages were below 4% over the last 13 years. So even when we had a major crash in 09, the prime rate went down to 3.25, and I was getting most loans at about 4.25. Prime plus 1 for investment property loans is pretty common. So 4.25 was really my best rates for 10 years. And then in the pandemic, I was able to lock a few just under 4. But as investors, it's still incredible. So yes, this is a great time to buy property while rates are low. Lock in your rates for as long of an amortization period as you can. And fix that note. If you're doing commercial, loans and you can't lock it for 30 years, fix that rate, maybe 7 or 10 years instead of 5 if your lender gives you that option. But absolutely, yes, rates are going up. Yes, that will impact values in some way if they continue to go up higher. But slightly higher rates than where we are today does not scare me or keep me from wanting to buy at all.
Yeah, I think there's a couple of things in that, and I think we're in lockstep. First and foremost, it's the lowest in my investing lifetime as well. I think there's one little wrinkle there. I think we've come off the bottom, and we're going to be ticking up slowly for the next 3 to 5 years. You can't print 20 or 25 or 40% of known cash in a 18-month period and not have unintended consequences. One of them is going to be higher rates, in my opinion.
I agree completely.
Yeah. So that is something you should bank on, or at least I should say I am banking on, right? If I want to buy a property in December, my suspicion is rates will be higher than July. I just need to run the numbers at higher rates.
Right.
And like you, I was thrilled the first time I got a loan under 6%. I'm like, oh my God, this is like found money. It's like, whoa, right? So again, you can look at the situation with rising rates and be somebody who is discouraged and not move forward, or think we're going to go lower and not do anything. It's not going to be helpful. Like Anna said, I think the right answer today is lock in as long as possible. And if you're doing residential, one rental at a time, go get that 30-year money. Even if it's 4%, go get that money. Would you agree with that?
Absolutely, 100% in agreement. So, you have to look at things historically over time. A lot of newer investors are short-sighted because they've only seen these rates, really, really low. 2 years ago, just over 2 years ago, in December of 2018, we locked in a rate of 5.08, and we were doing the happy dance, jumping up and down because we locked in so low, right? Yeah. We never thought rates would go down to where they are today. And again, that's commercial. So residential was probably around 4 at that time, right?
Yeah.
So, and we're still happy with that 5.08 rate. Now, granted, do I wish I wasn't in a prepay penalty and I could have refied it low? Yes, I do, right? But it's all perspective and it's all relative. The reality is prices are higher now too. So even though rates are lower, prices are now higher. But it averages out really closely to where we were at the end of 08. It just was the reverse, lower prices, higher interest rates. So rates have to go up. I think the caution is don't do any short-term rates. Don't do bridge debt and think that rates are going to be the same in a year or 2 or 3 when you're done with your value add deal. I'm seeing a lot of that right now, Michael, and that really scares me for a lot of investors. I'm seeing deals that they're doing bridge debt and they're like, well, we'll get out and we'll sell in a year or 2 and we'll sell top dollar. And our rates aren't going to be much different. So they might model a quarter point higher. I mean, we've already gone up half a point in 2 weeks, right? And so I think that's a dangerous play. I think if you're going to do any kind of short-term rates, you better model out that in 3-4 years when you have to refi, that rates are going to be back up to 5. I'm using 5 in my modeling because at the very highest, when they were 5.25 on commercial, the market started to teeter a little bit. The market started pushing back. The rates were too high. So I think with all the money printing that we're doing, I think that if rates get too high above that, there would probably be a lot of shock waves and the Fed would quickly reverse course like they did right after the end of 2008 when they lowered rates again in the beginning of 2018,
right,
when they lowered them again in 2019. So I'm modeling 5 for my future refi projections on my loans that are 20 to 25 year AM with a 5-year fixed rate. And I'm trying to lock my rates in for 7 to 10 and pay a little higher in order to do that right now.
Yeah, I think this is an environment, again, if my opinion is we've come off and we're going to have 3 or 4 years. I don't see I think we've seen the fastest rate of change, and it usually happens in the beginning, but I think we're going to be higher in 3 or 4 years. So yeah, I think the answer is lock in as long as possible, 7 or 10 if you can in commercial. And again, folks, 30, don't be a fool. Don't get a 5-year ARM because you think rates are going to be suddenly 2% again.
Yeah.
Go get 30-year money.
Yeah. And if you can qualify for it, definitely do that. If for some reason that these new rules come out on April 1st that are coming through the traditional, 1 to 4 unit property, investment property financing through Fannie Mae, then go to a portfolio lender that's a little bit smaller. Their rules are going to be a little more flexible. Their rates are going to be a little bit higher, but they'll lock you into those rates a little bit longer than private money would, for example. So if I've got a 25-year AM deal and I can lock in a really low rate for 5 years and I have the right to relock after that, I'm not afraid to do commercial money. If you need speed, you go commercial, but until you've used up your 10 properties that are Fannie Mae 30-year lowest rate interest rate you will get deals, keep going that route until you can't any longer.
Yeah, I hope people hear that and appreciate that. If you can go get 10, I mean, I would love to get 10 Fannie Mae loans. I can't get those. Go get them. And again, rising rates doesn't mean you stop doing deals. I've done deals. I think the highest interest I paid on a 30-year mortgage was, I think it was in the high 7s back when I started in December of 2002, I think. Again, you still do deals. You just got to run your numbers, know your market, make sure you get cash flow. Rates could go high enough where prices are impacted. I don't think we're near that level now because demand is so out of whack with supply. But, debt's going to be more expensive going forward.
Yeah, again, that's very, very regional. Again, some cities are in hyper supply. And for those markets, if rates go up and property values come down, you might have a little more pain. But in most major markets right now, we're not quite at that point anymore.
Yeah, very cool. Awesome, Anna. Thank you very much.
Thank you.